Hey traders, you're welcome back to the Forex Geek channel. In this video, we are diving deep into price action with divergence. Now, it's one of the most powerful techniques to identify potential trend reversals and continuation setups. Okay, so if you're struggling to catch high probability trades, then this strategy is going to change the way you trade forever. All right. Before we get started, just smash that like button and subscribe to the channel if you want more trading strategies like this. Now, let us just get into it. Okay. Divergence occurs when price action moves in one direction, while an indicator like the RSI or the MACD or the stochastic moves in another direction. When you have price moving in one direction and you have any of these momentum indicators moving in the opposite direction, then you have a divergence. So this signals that momentum is weakening and that a potential reversal or continuation could be on the way. There are two main types of divergence every trader should know. The first is regular divergence. Regular divergence signals a potential trend reversal. It signals a potential trend reversal. It occurs when price forms higher highs. When price is forming higher highs, let's just see if we can find an example. Okay, I think we have a brief example here. You can see we had higher highs there. When price forms higher highs, while the indicator form lower highs. When price form higher highs, while the indicator form lower highs, it's a bearish divergence. Or when price forms lower lows. When price forms lower lows, while the indicator form higher lows, it's called a bullish divergence. For example, you can see what happened here. You can see this lower low form. You can see higher low form. Can you see that? You can see higher low form. Can you see that? You can see higher low form. So this shows a bullish divergence. Now, the second kind of divergence that we have is the hidden divergence. The hidden divergence suggests trend continuation. It happens when price forms higher lows while the indicator forms lower lows. For example, see what's happened here. Higher lows, indicator form lower lows. You can see that lower lows. Now, this is a bullish hidden divergence. All right. On the other hand, when price is forming lower highs, but the indicator is forming higher highs, it's a bearish hidden divergence. All right. So understanding these patterns helps traders anticipate market moves rather than react to them. Now, to spot divergence, you will need an indicator that tracks momentum, and that is the reason why I added these three indicators. You don't need the three of them at once, okay? You can actually do with one of them, all right? But these are the three main indicators that is usually used. They are the most commonly used indicators for divergence trading. The RSI, Relative Strength Index, which is great for spotting overbought and oversold conditions. Divergence on RSI is often a strong signal. Then for the MACD, Moving Average Convergence Divergence, it is useful for identifying momentum shifts and trend reversals. Then your stochastic oscillator is another momentum indicator that works well for divergence signals, especially in ranging markets. Now, these indicators work best when used alongside key price action levels like support and resistance levels. Okay? Important. and then also trend lines alongside candlestick patterns. So now that we understand what divergence is and the indicators used to spot it, let's talk about how to trade it effectively with price action. So here's a step-by-step approach. First of all, identify the divergence. Okay, look for a mismatch. We've already talked about the regular divergence and the hidden divergence with examples. So look for a mismatch between price movement and your indicator. Could be higher highs versus lower highs. Could be lower lows versus higher lows. Higher lows versus lower highs. I mean higher highs versus lower highs. Yeah, whether it's a bearish divergence or a bullish divergence, look for a mismatch. All right. Secondly, confirm it with price action. For example, you can see what we had here. You can see this is a bullish divergence, right? A bullish regular divergence, because you can see that price was making lower lows, and then indicator was making higher lows. So you confirm it with price action. You can check for candlestick patterns like pin bars, engulfing candles, double tops, double bottoms at key levels. For example, you can see we had a doji here, and we still had an engulfing candle. You can see engulfing a candle here, engulfing candle here. So that confirmed the buy trade. So once you have marked your key levels, strong divergence signals are even more effective when they occur near support, resistance, or trend line. So mark your key levels and then you can enter your trade. Once you have confirmation from price action, you can enter the trade with proper risk to reward ratio. Okay, then set your stop loss and take profit targets levels rather. Always place your stop loss beyond the most recent swing high or low. All right, to avoid getting stopped out by market noise. Now, using this method ensures that you are trading with higher accuracy instead of relying purely on indicators. Okay, so that is the reason why you should be looking out for candlestick patterns as well, chart patterns, that can confirm the signals given to you by the indicators. Now, not all divergence setups are created equal. Okay, here are some tips to avoid false signals. The first is avoid divergence in a strong trend. Okay, if the market is in a strong uptrend or downtrend, divergence alone is not enough to justify a trade. Okay. Secondly, look for confluence. The best divergence setups align with support and resistance levels, Fibonacci retracements, or major chart patterns, and then use multiple time frames. Checking for divergence on higher time frames can help you filter out weak signals on lower time frames. Okay, so by keeping this in mind, you'll avoid many low quality setups and focus only on the best opportunities. All right, and that is how you can use price action and divergence to improve your trading. Remember, the key to success is practice and patience. The more you backtest and refine your approach, the better your results will be. If you found this video helpful, hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Also, let me know in the comments, do you use divergence in your trading? If so, which indicator do you prefer? Let us start a discussion in the comment section. In the meantime, thank you for watching, and I hope to see you in the next video.